Welcome to The Explainer. Today, we are tackling fixed income. Now, you've probably heard the term, and maybe you think of it as, the boring part of investing. Well, we're going to show you why it's actually one of the most powerful and interesting forces in all of finance. So, let's break it down. Here's how we're going to do it. First, we'll start with a really fundamental choice: owning versus loaning. Then, we'll get into why huge organizations like governments and companies even need to borrow money in the first place. We'll look at the short-term IOUs, then the long-term ones. And we're going to finish with the single most important rule in bond investing. It's called the seesaw effect.
All right, part one. Before we dive into all the details, we have to start with a big picture question. And it's a question that every single investor, you included, really needs to answer for themselves.
Yeah, what are you trying to do with your money? I mean, really, what's the goal? Are you playing the long game, trying to get maximum growth for something way down the road? Or do you need a steady, reliable stream of cash coming in right now? Because your answer to that question sends you down one of two very different paths.
And this slide just lays out that choice perfectly. So on one side, you've got Stan. He's all about growth. He buys equity, stocks, which means he actually owns a tiny piece of a company. He's betting that its value is going to skyrocket over the next 30 years. But then you've got Jane. She's retired, and she needs income like today. So she invests in a bond fund, which means she's not owning, she's loaning her money in exchange for getting regular interest payments back. And that right there is the whole idea of fixed income. You're the lender.
Okay, so let's flip the script for a second. Let's look at the other side of this deal. Why would anyone need to borrow your money?
It really comes down to scale. I mean, think about it. Governments have to fund enormous projects. We're talking infrastructure, healthcare, defense, and corporations. They need huge amounts of cash to grow, to innovate, to build new factories. To get that kind of money together, it's often way more efficient to borrow little bits from thousands of people, like you and me, than to try and get one single giant loan. And for a big company, this is a really strategic choice. Sure, they could go to a bank, of course, but bank loans can have really high interest rates and a lot of strings attached. So by issuing these fixed income securities directly to the public, they can often get a much better deal. They're basically cutting out the middleman and getting a more favorable rate on the money they need to borrow. Okay, so now we know why these big organizations borrow. Let's dig into how they do it. And we're going to start with the short-term stuff. Think of this as the world of quick loans.
So these are called money market securities. The key things you got to know are, one, they're short-term, we're talking less than a year, and because of that, they're considered very, very safe and very liquid. They're basically a place to park cash for a little while where it can earn a bit of interest without you having to worry too much about risk.
And here are the main players you'll find in this short-term game. You've got Treasury bills or T-bills from the federal government, and similar stuff from provinces and cities. Then you have what's called bankers' acceptances. That's basically corporate debt that's guaranteed by a big bank. And finally, you have commercial papers, which are also from big corporations, but they aren't guaranteed by anyone but the company itself.
And what's so cool about this is how it maps out the #1 rule of investing, right? Risk and return. Way down at the bottom, you have those super safe T-bills backed by the full faith and credit of the government. But as you move up the ladder through the municipal papers, the bankers' acceptances, and all the way up to commercial papers, the potential return gets higher, but so does the risk, because you're moving farther and farther away from that rock-solid government guarantee. Okay, time for the main event. Let's talk about the long-term IOUs that are really the foundation of this entire world. Let's talk about bonds.
Now, you don't really see paper certificates like this anymore. It's all digital. But this old-school design shows you everything you need to know. A bond is a formal contract. It's a promise, written in stone, from a borrower to a lender. And every single bond out there is defined by these 4 key things. First, who's the issuer? Who's borrowing the money? Next, what's the par value? That's the face value of the loan, usually $1,000. Then the important one, the coupon rate. That's the fixed interest rate the borrower promises to pay you. And finally, the maturity date. That's the day the loan is over and you get your original $1,000 back.
So this example makes it real. Karen puts 10 grand into a bond with a 6% coupon. Now, because most bonds pay out interest twice a year, or semi-annually, her payment gets split in 2. She gets a check for $300 every 6 months, just like clockwork, until that bond matures. That regular, predictable payment, well, that's the fixed income we've been talking about.
All right, let's get to the most fascinating and, frankly, the most critical concept in all of fixed income. Seriously, if you only remember one thing from this whole explainer, make it this.
There it is. It feels a little weird at first, maybe a little counterintuitive, But this is the iron law of the bond market. When new interest rates out in the world go up, the price of your old bond goes down. And when new interest rates go down, the price of your old bond goes up. They always move in opposite directions, just like a seesaw.
Let's just walk through why that happens. Okay, so imagine interest rates across the whole economy rise. That means brand new bonds are being sold with higher, more attractive interest payments. Well, all of a sudden, your old bond, with its lower, locked-in rate, it doesn't look so hot anymore, does it? So if you wanted to sell it, the only way to make it competitive is to lower its price.
Now let's flip it around. What if interest rates fall? Well, now all the new bonds being issued have these lower, less attractive coupon rates. And suddenly, your old bond, with its awesome, higher, locked-in interest rate, looks like a fantastic deal. People want it. And when demand goes up, so does the price.
Here's the logic in a nutshell. Think about Yolanda. She's got a bond that pays her 7% interest. But this year, anybody can go out and buy a brand new bond that pays 8%. So why on earth would anyone buy her less attractive 7% bond for the full price? The answer is they wouldn't. If Yolanda wants to sell her bond today, she has to drop the price. She has to sell it at a discount to make it a fair deal for a new buyer.
And this slide just shows you the math perfectly. Check it out. On the left is James. He's the original buyer. He paid the full price, $1,000, and he gets a $100 coupon payment every year. His return, or his yield, is a simple 10%. But then market interest rates go up, and the price of his bond falls to $800. Now look at Margaret. She buys that same bond from James for just $800, but here's the key. She still gets that same $100 coupon payment. But for her, $100 on an $800 investment, well, that's a return of 12.5%. By paying a lower price, she locked in a much higher effective yield.
And this table basically pulls it all together for you. It's the whole relationship in one spot. If rates in the market go up, the bond's price falls to a discount, and a new buyer's yield is going to be greater than the original coupon rate. If rates go down, the bond's price rises to a premium, and the new buyer's yield is less than the coupon. That's the seesaw, right there.
So here's the final thought to leave you with. The next time you see the financial news going crazy, obsessing over what the central bank might do with interest rates next, it should all make perfect sense. It's not just about abstract numbers. It's about this seesaw. Every single person in the bond market is trying to guess which way that seesaw is about to tilt. And now you get it too.